Hi, this is Jim Cunningham. Today we're going to talk about when should you have a comprehensive financial plan? Should you? When should you do that? Should you do that when you start investing? Should you do that when you retire? We're going to talk about this, when and how this all works. I've got Shannon Behan and Alyssa Kroger from Ascent Wealth Management. They're both certified financial planners. And we're going to talk about types of advisors, what to look for, certifications, independence. What does independent mean? What does it mean to be part of a larger organization where you might have to sell certain products? And so they're going to unpack that. We'll talk about flexibility. We'll talk about when when a financial advisor is a fiduciary. A fiduciary is somebody that has to put their own interests before, or put their client's interests before their own interests. So believe it or not, lawyers have to do that. A lot of people think, well, lawyers are just in it for themselves. It's actually not true. The lawyer needs to put the interest of the client before that of the lawyer. And the same is true if the financial advisor is a fiduciary. And we'll talk about breadth of offering, bench depth, which is great. It's great if something happens to your advisor, like what happens to your portfolio if this one person something happens to them, and cultural fit as well. So if you're watching this on YouTube, we're recording this live, but if you're watching it on YouTube, go ahead and hit subscribe and this will pop up in your feed. And we really appreciate that. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I've got over 30 years experience. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust, and probate law, which means I've taken an additional bar exam in addition to the normal California bar exam, and have a level of competency that's recognized by the state bar. I'm a real estate broker. I'm securities and insurance licensed, and also a pilot. And these are the lawyers, if you're watching this on video, these are the lawyers at our firm. And we are dedicated to all things estate planning, wealth building, multi-generational planning. Essentially, we're lawyers for the mass affluent, sort of the private client lawyers for the mass affluent. And we have Alyssa and Shannon here from Ascent Wealth Management, and they've got the other partner, Christina, who's not joining us here today, but a great team. And, many of our clients use Ascent Wealth Management, and they really like working with you. And this is important disclosure. Why don't you ladies talk about the disclosure?
Yes, we are financial advisors. We will be speaking to you today, but we are not giving you financial advice. This is just broad general comments, and you need to speak to someone specifically about your situation before acting on anything we talk about.
I'm a lawyer. When I talk, this is not legal advice. When I use the word you, I'm not talking about you. I'm just trying to explain something. So it's a little bit like watching Shark Tank, where they say, no offer is being made to you to buy anything. Similar thing here, right? You're watching this. We're here to teach the people, to sort of do a brain dump, if you will, and help guide you watching this video. But really, don't rely on this as legal advice or financial advice. So, Shannon and Alyssa, I will let you take it away.
Thanks, Jim. So we're going to talk a lot today about what financial planning is, what are some of the questions that financial planning helps answer. But in my mind, really where that all starts is who does that financial planning for you? And a lot of the times when you look out into the marketplace, you'll see a lot of different titles used for financial advisors or other people that are offering similar services. But they're very different. A lot of those titles that we're showing on this slide on the right-hand side don't have any specific requirements or certifications that are necessary in order to use those words. Like anybody can go be a financial advisor. There's some exceptions, like a registered representative. You do need to have some specific licenses, but something like a financial consultant, anyone can open up shop and call themselves that without any backing. So when we think about who is putting together a financial plan for you, that's one of the most important things, is thinking about certifications. How do you know you're working with somebody who's reputable? I'm obviously biased because our entire team here is certified financial planners, which is really kind of, in my view, the gold standard, my view and a lot of other people's views as well, the gold standard in financial planning. We go through a very rigorous education requirement, experience requirement, and also some testing as well to be able to use those credentials. All three of us are also accredited estate planners as well. So there's other certifications out there that will help give an indication of someone's expertise. So really, that's a good place to start looking. The other thing that is super important when you're thinking about who you're going to work with is this idea of independence versus being an employee. I'm not going to throw anybody under the bus, but you'll see a lot of commercials with financial names that you recognize. And the advisors that work for those firms are, in fact, working for those firms. They are employed by those firms. So what that oftentimes means is that they're very limited in their options that they have available to use for their clients, whether that's from an investment strategy perspective or something like a tax mitigation strategy, or even planning capabilities that they have. We are independent here at Ascent Wealth Management, which means we can go out and look at the entire investable universe and offer solutions that we think are the best in terms of, best quality, best cost effective solution. So we're not handcuffed to offering any sort of proprietary products or anything like that. That really goes in line with that idea of flexibility as well. One of the things that I see a lot, and I know, Jim, we've talked about this a little bit too, is when you Google, questions you should ask a financial advisor or those kind of things, you'll see this idea of a fee-only advisor. And what that means is that that particular person only charges financial advisory fees, which is a specific type of fee. So they don't do anything that generates what's called a commission. Now, without going into too much detail about that, in my view, what that does, if you go to a fee-only advisor, is it really limits the options that they have available to you. When you have someone like us who is licensed in multiple ways with different organizations, we have options that we can use in specific situations to solve specific problems that a fee-only advisor might not be able to use. So it's important to understand how an advisor is paid, and I encourage you to ask questions when you are meeting with someone so that you're really understanding. Any great advisor will be able to provide you with a very transparent fee proposal as part of their engagement with you to begin with.
Yeah, and Shannon, you're mentioning something when somebody says they're fee only.
Mhm.
What I hear, understanding, with my understanding of the industry, is they're less regulated than if they weren't a fee only advisor. So this is really important to understand when they say, "Oh, I'm fee only." That means that they're not being regulated by additional government agencies, typically federal agencies. So that's a really important thing to understand. And you make a really good point on a very high level. Is if the universe is like a piece of pie, right, or a pie, a circle, they're going to be a subset, and they just simply won't offer some things that frankly may be appropriate. Look, they might not be appropriate for an investor, but they might be appropriate for investor. But that'll never even be brought to the conversation because they lack the licensing for it. And this is probably, I would say, in terms of regulated spaces like law, medicine, financial advisory, this is a very heavily regulated industry. And when you're fee only, you're opting out a lot of that, opting out of a significant chunk of the regulation.
Absolutely. And this kind of connects to that idea of who is a fiduciary and in what capacity do they have to be putting your interest first. And there's different rules for different types of licensing that you have, so that can change. But one thing you know for certain is that if you are working with someone who is a certified financial planner, they are held to the highest fiduciary standard that is out there in the industry. Other things here to look for: breadth of offering. That really just goes to, somebody who has expertise in other areas. We'll talk a lot today about kind of the areas that financial planning encompasses, making sure somebody's not just talking to you about only investments. What should you be investing in? That's really the smallest piece of financial planning. Making sure that you are working with a team is often advisable. Again, I'm kind of biased there because we have such a strong team, but we're seeing this in other industries as well, like with CPAs. We have a lot of clients who are working with CPAs who, are solo shops and don't necessarily have that bench depth, and their CPA is getting older and they're thinking about, okay, what happens when he's ready to move on? The same thing is true of financial advisors as well. You don't want to be left in a lurch there. And finally, cultural fit. You got to like the person that you're working with. It's really as simple as that.
Well, it's hard to not like you, Shannon, Alyssa. I mean, come on, let's just face it. All right.
Yeah. So for us as certified financial planners, we really look to the Certified Financial Planners Board and to help us define and lay out what we view as the aspects of financial planning. I would point out again here that investment planning is really just one piece of that overall comprehensive planning. And in our view, from our office, it's really, again, kind of the last piece. You lay out the puzzle, and then you fit in the puzzle pieces that are in their right spots, and that's what we view the investments as. basic financial planning, just cash flow, making sure that we're saving appropriate amounts. We'll talk today about retirement, some of the considerations there, what your financial planner should be taking into account. Tax and estate planning, that's something that we work on together with Jim and his team quite a bit. Risk management and insurance planning, making sure that you are covered is certainly a huge part of your overall financial life. And then finally, psychology of financial planning. It's really kind of that behavioral piece of the financial planning picture, which I think oftentimes gets overlooked, but we've got some information to show you today about why it is so important.
Yeah, the psychology, I think everyone watching this, when you get, there was a bit of a drawdown in the market last year, kind of toward the middle of the year. And when you see the value of your portfolio go down, it's like, oh my gosh, you get nervous. It's like this upset tummy factor. And, the older people get, and you two are younger and I'm a little bit older than you, but the older people are, you just don't have the time to earn it back. So it can be really stressful for people, especially in a volatile market, where volatile meaning up and down, up and down, up and down. That can, and the ups are great, right? But the downs really stink.
Yeah,
So,
nobody complains about volatility on the upside. So one of the things that we think is really, really important when it comes to financial planning is, in the title of our talk today, we're talking about comprehensive financial planning. And really what that means at the highest level is that whoever is doing your planning needs to know all aspects of your financial life. And so if you've got multiple advisors looking at different parts of the financial picture, that can really be detrimental to the success of your overall plan. Not having that coordination in all parts to kind of make sure that everybody's rowing together. There are some consequences that are really simple, like we put tax planning consequences up here, but if you sell an investment and you realize a loss, if you've got that investment in another account and you've got, you buy that position in another account, two advisors doing separate things, you might lose the ability to deduct that loss on your taxes. And that's a gone opportunity that you cannot get back. So it's things that are that simple, but it's also much more complex when it comes to things like your estate plan and making sure that, all of the accounts are registered in the correct way, that beneficiaries are listed appropriately. If whoever you're working with doesn't have visibility to all of your accounts, you're really kind of tying one of their hands behind their backs and sending them into the ring in terms of making sure that things are working together for you. We always talk about this idea too of the all your eggs in one basket. This is something that we hear from clients quite a bit when we're talking about, moving assets under one umbrella and having one advisor oversee everything. And while that's certainly, moving all of your eggs into one planning basket, the real danger in having all your eggs in one basket comes with investments. And so as long as that advisor is making a well-diversified investment plan, part of their overall financial plan, you won't have the concentration risk that people think that you have by having everything with one advisor. It's really the danger comes when you've got multiple people doing multiple things in your investment portfolio.
and then talk about fees. You know, I would say I've been practicing law for 30 years, and what we've seen just an industry trend in the financial services, you've had fee compression, right? There's been a lot of fee compression, I would say, broadly speaking. You're seeing it in real estate now, right? They came out with the settlement and that's kind of unraveling a very long history of higher fees than will be in the future. So maybe talk about how do advisors charge, right? Are there hidden fees? And then are there like regulatory fees that everyone's going to have to pay for the investment? Just maybe walk through that a little bit.
Sure. So the different layers of fees, if you will, if you are investing, even if you're investing on your own, you don't work with an advisor, you are paying fees. If you hold any sort of fund, you're paying underlying fees within that investment vehicle. You might not see them come out as a line item on your statement, but you are paying for investment fees. Those managers that run the portfolios that are making the decisions about what's inside those funds, they are being compensated. Depending on what custodian you're at, it's very likely that you're paying some sort of trading fee to the custodian as well for when you buy and sell securities. Again, even if you're doing it on your own. So there is some cost to investing at its very simplest form. even if you're doing it yourself. And then when it comes to advisors, like we talked about on that first slide, different advisors will charge in different ways. But when we think about from a, one of the risks of having too many advisors and potentially losing out on some fee efficiency there is when you think about an asset-based fee. So quite often advisors will charge a fee that is a percentage of the assets that you have invested with them. That's one option that we have when working with clients. And our fee structure is set as such that if someone has a certain threshold of assets with us, we bring that fee down. And many advisors have that same sort of setup. So if you have assets with multiple advisors, you may be paying kind of their highest threshold of fee, where if you combine things with one advisor, it could push those fees down. So kind of that economies of scale idea.
Yeah, and those can be significant. And over time, it may not seem like, oh, it wouldn't make that much of a difference, all eggs in one basket. But when you look at it over maybe a 20-year time horizon, paying more in fees really does materially impact your return. So it's very important to pay attention to that.
Well, and I would say I want to add just and touch on that. Shannon and I both came from another firm without naming the firm. It's a lower cost firm that can offer a breadth and depth of offerings to clients, but they do have proprietary funds. And so what you'll see is a financial advisor, while it might not cost much to access that financial advisor, they might put you in a portfolio that's professionally managed that then has their own proprietary funds. So if you add everything up, they're incentivized to give you their proprietary funds, which they charge an expense ratio on. They're then charging for that portfolio, and you're getting an asset management fee. So it's on top of, on top of, on top of. And so your total fee ends up actually being quite significantly more than what you would have access to if you were going to an independent advisor.
Yeah, I mean, it's like going to Trader Joe's, and if you're looking for Oreos, you're not going to find them. You're going to find the Joes,
Yep.
not the Oreos.
Right.
Anyway, all right. A bad attempt at humor.
Yeah.
Right.
So when we start to look at areas of financial planning, I think the things that comes to mind for most people is retirement. So this idea of when you should have a retirement plan in place, I think that a lot of our clients and a lot of people that we engage with, we find are in those years nearing retirement. And the reason for that is depicted on this slide here. There's really kind of two phases of life, if you simplify it as much as we can. There's the accumulation phase when you are working, you're saving into whatever savings vehicle you have available to you. And the goal is simple. It is really just to get that balance big and get that nest egg as large as possible. And in that phase, the endpoint is somewhat controllable. There are some exceptions where there's forced retirement and that sort of thing, but generally speaking, you get to decide when that phase of life is over. And there's certainly risks involved there in terms of certain investment risks and keeping up with inflation, liquidity risk. What types of investments are you in? Making sure that you've got cash flow to meet your basic needs. And so there's certainly some value in having a financial planner in that phase of life to help deal with those risks. But when I mentioned that most of the clients or a big chunk of the clients that we work with are nearing retirement or in retirement, it's because at that point we're transitioning into this phase called distribution. And that is a very uncertain phase of life, right? If things go well, that could be 30, 40 years. So the endpoint is really unknown. It's really how long you're going to live. And when we talk to clients about what their fears are, I don't know about you, Alyssa, but I think for myself, the number one thing that I hear is people don't want to run out of money.
Longevity risk.
So that distribution phase has some unique risks to it, in addition to the risks that have always existed, like longevity risk, tax risk. When you start to create your own income stream, a lot of those ways that you create your own income stream have income tax consequences to them. We also have to think about estate tax. What does your plan look like in transferring those assets to your heirs? So having that, transition into the distribution phase of life makes things much more complicated. And so there's a lot of value in having an advisor kind of guide you through that phase. We talk about some of the things that are really important when you're nearing retirement. We will, like on the next slide, there's a lot of different things that we can plan for. Like what is your lifestyle going to look like? How much will, I get asked a lot, how much do I need to retire? Well, that totally depends on what your lifestyle is going to be like and what state you're going to live in. And there's a lot of different variables there. One of the really important things that we look at for clients is the savings strategy. And so this is something that's important both in accumulation phase and right as you're nearing retirement, is evaluating, do I make a traditional contribution to a 401k or to an IRA, or do I make a Roth contribution? And this is something that seems like a simple question, but there are so many different variables that come out of that decision. You have to take what's called required minimum distributions in retirement from those pre-tax contributions. So essentially what you're doing is just kicking the tax can down the road. And for some people that could make sense, but for some people it might not make sense. And so that is a simple decision that can have, if we are talking about years of accumulating assets, that can have ramifications that are, millions of dollars in retirement, depending on what type of contribution you made.
Yeah, Shannon, this is really important because we see, we obviously we deal with people of all ages, frankly. So young, middle age, retirement, elder. But I will tell you that it seems like people who have some amount of wealth, it tends to fall into three buckets. It's either it's a business and a business owner, and it tends to be a lot of their wealth is tied up in the business itself, and that presents exit issues, that presents funding retirement issues. A lot of times we see people that their wealth is pretty much entirely in real estate. So you're not seeing the business side. You're not seeing the qualified, the 401k, the IRA. And then you see people who might work for a Fortune 100 or Fortune 500 company. And what they have is a really big, we have people with $10 million IRAs and a house. And it's really hard. I will tell you, if that's you, congratulations on saving so much. Once you hit your required minimum distributions, that is your taxes are going to spike. And this is, I think, the number one shocking thing that happens to people when they hit the required minimum distribution age of 73 is they look at this and they go, I got to take out 4% of 10 million. That's $400,000. I don't even need it. And now I've got a $200,000 tax bill. So that is really, if that's you, if you have a big retirement plan, this is really something I think that deserves some attention.
Absolutely. And you mentioned something else there about, kind of real estate and that being a big component of someone's net worth as well. And that is something that a financial planner should be looking at your real estate holdings as well. So often we see clients are dealing with advisors that won't necessarily address that part of someone's net worth because there's generally speaking not money to be made for that advisor, quite frankly, because it's not an investable asset. So they just sort of, skim over it and as part of someone's net worth. But you really should be working with someone who has the capability to help you evaluate cash flow on that real estate. If it's going to be part of your retirement income plan, the income that's getting kicked off from that property, is it cash flowing an appropriate amount? Are there changes that can be made? Depending on if it's an investment property, there's different strategies that can be utilized to help you move that equity into a property that has a better cash flow for you, without having to realize the capital gains that may be embedded in that particular property. So that's something that a good financial planner should be addressing for you as part of your overall retirement plan as well, is holdings outside of just your liquid investments. And also your insurance. This is something I think Alyssa is going to talk a little bit about it later as part of the overall financial planning. But insurance, making sure that you are having regular reviews there on all your policies is very important. And that income distribution plan, I don't want to beat a dead horse, but that's really one of the hardest things that I think people don't think about is how am I going to turn this nest egg into a paycheck for myself? And that's part of the retirement planning exercise. So when we think about retirement income and creating a plan for that, how do we create that paycheck for you? How is it going to be taxed? If I made pre-tax contributions, I'm going to have to pay income tax on the way out. If I made Roth contributions and I'm utilizing those, no taxes. So that's great. But it could be better for my overall estate plan to, in fact, utilize some of those pre-tax contributions. So that needs to be taken into account. And are any of your sources of income guaranteed? We used to see a lot more clients that had pensions. We don't have those quite as much now. But beyond Social Security, do you have any sort of reliable guaranteed income, whether that's, something that's generated by an annuity? How does that fit into the overall plan? How much are you going to have to rely on your portfolio? We help clients. Go ahead.
Yeah, well, I was going to say this is really where the utility of a certified financial planner comes in, because I'm going to be 55 next month. And so you start thinking about this, like the runway is shorter every day. That runway is shorter by a day, and you really start looking at the math of it. When should I take Social Security? What month of what year should I take? And you can get as granular as that. How, should I be what should my investment makeup look like as I approach retirement if I'm nervous about a drawdown in the market? By drawdown, meaning stocks go down, like the prices go down. That's a drawdown in the market. So, and I think this is really helpful. The other thing to do is create a budget. So in retirement, you say, look, we want to go to Europe 3 times, and we want to fly first class, and then we want to go to Asia twice, and we want to go to, Galapagos Islands or whatever it is, and map it out like this is kind of the bucket list thing, and quantify the spend, and you're able to take a little bit more control of it. So I know it sounds like maybe, planning for vacations isn't really a lot of fun a lot of times, but the 60s, when you're in your 60s, that's kind of the go-go years, right? It's like, we're going to go and do, because as you age, you may not be as inclined to do it. So I think budgeting and planning makes a lot of sense. And I will tell you, as a man, it is common. This is probably also common with women. Every guy that I talk to in estate planning, I ask pretty much everyone, what's your number? And a lot of times the wife, if it's husband and wife, the wife's like, what are you talking? What do you mean? What's your number? He's like, well, it's 20 million, or it was 10 million, or whatever it is. But there's a lot of people have this number in their head that they need to get to. I think that's a visceral thing. I think it's a comfort level. I think it does not necessarily correlate with needs in retirement. It's fairly arbitrary in my mind. So if that's you, if you're a guy or a gal with a number in your head, that's a good place to start, and work backwards on it, right? What do you really want out of the remaining years you've got on this earth? What do you want to do? What do you want to accomplish? I mean, we've in our law firm, we've merged several practices. The oldest attorney was 95 years old. And
I don't think I want to be working when I'm 95.
Still sharp, but yeah, there you go.
Another huge component of financial planning that we work very closely with Jim and his team on is estate planning. Tax is included in here as well, which does include income taxation, which we do a lot of planning there. But more and more, especially recently with that sunset looming, we're talking about estate tax planning as well. We are located here in California, but we work with clients all over the country. So we're also working with clients in states that have their own estate tax or death tax or inheritance tax, whatever that state calls it. So these are things that a financial planner should be considering for you, making projections out into the future to see if it's likely that you will cross over certain thresholds, and then making suggestions for ways to kind of mitigate those income taxes that you're going to be paying. And quite often there are ways to do that. I don't know about you, but if assuming I accumulate an estate that is subject to estate planning taxes, I certainly will not want 45% of my estate above that threshold to go to the government. And there's ways that we can do that. And there's strategies that we can do during your lifetime. There's strategies that we can put in place that spring upon your passing. We are not attorneys here, so we work very closely with Jim and his team. We make suggestions in terms of how certain vehicles, like a charitable trust, for example, may fit into someone's overall financial plan, and show you visually what that looks like, how that impacts overall taxation.
Yeah, and one thing that people don't, a lot of people, we have a webinar coming up on retiring in California, essentially like what that looks like. And a lot of our clients move from other states to California to retire. And I know we were talking about that before we started, and you're kind of like, what? People move to California? Well, there are a lot of reasons to be here, and a lot of reasons to leave. It's obviously a personal choice. But one thing to think about is if you are in a community property state and then you move out to a separate property state, that affects getting a full adjusted cost basis at death. And this is one of the #1 advantages of living in a community property state such as California, is when one spouse dies, the surviving spouse can sell everything. You don't have to, but you could sell your rental property, your investments and not have any capital gains tax, right? So if that adjusts to the date of death value and those assets are sold at the date of death value, then broadly speaking, you're going to have this exemption from capital gain, and that's very important to pay attention to that, because if you move out of California, you may lose that, right? You may not. It becomes more complex. Colorado is not a community property state. A lot of people go, well, it was part of the old part of New Spain, so it's community property, but they're not a community property state. So very important. It's also important to pay attention if you're a California resident and you have property in New York or you have property in Oregon. Those states, and we were working on a case this morning about that, those states, even if you're a California resident, have a separate death tax, a state level death tax. So something to really pay attention to. And this is really the value that working together with the lawyer and the financial advisor and CPA working together, there's a real benefit to that.
Huge opportunity ahead of that 2026 sunset. I think we did a webinar that was primarily about this, so we won't, beat this to death.
Yep.
But we've got some options here. Time is running out. It's going to be 2026 before we know it. So it's important to kind of get those evaluations and plans in place. And then I think the other thing that's not really being talked about as much with the sunset is that income tax brackets are also going to revert higher. So there's some opportunities there to do some income tax planning as well. We talked about the types of contributions that you make in terms of retirement contributions. There's some opportunities to do things like Roth conversions in order to kind of mitigate some of those future tax impacts. There's other strategies that a financial planner, especially us, can recommend that are, that can take advantage of certain tax credits or certain deduction offsets that are very unique. And even down to the way that financial planning fees are billed. Jim, I should have mentioned this earlier when we were talking about financial planning fees, is that Tax Cuts and Jobs Act of 2017 made it so that you can't deduct asset management fees anymore. However, if you work with an advisor who's able to charge you a fiduciary financial planning fee, there's certain situations where that is a deductible fee. So that's something that, working with a financial advisor that has that flexibility in the way that they charge fees can also be beneficial to you in the right situation.
Yeah, and not all financial advisors can do that, right? So it's very important to note. So on a very high level, if you don't know anything about what we're talking about, 2026 sunset, we are not talking about the sun going over, looking west at the end of the day. We are talking about the sunsetting of the expanded death tax exemption, which you can think of it as a coupon. Right now, it's over $13.6 million per person. So a couple can leave a little bit more than $26 million tax free. That $26 million number is getting cut in half. So if you're an individual, it's going to go down to about $7 million. So it's very important, if you have a house, an investment portfolio, and you have an IRA, up to 95% of that IRA can go to tax. 95%. That's because if you have an IRA in your estate, your heirs will have to pay 45% death tax on, let's say it's $1 million IRA, 45% death tax. And then when they take the money out, they have to pay income tax on that money. So, and as you said, Shannon, the income taxes are going up. So very important, if you have a larger estate, if you're a single person with an estate of over 7 million or a married person with an estate of over 13 million, and you have IRAs, you really should be looking at a Roth conversion before 2026, right? Before that, in 2024, 2025, because those highest federal rates are going to go from 37 to 39.6%. The math really kind of stops working for a lot of people at, I think, the 22%, 24% tax bracket on a Roth conversion. But this is, again, it's function of math. This is why you work with a certified financial planner. But certainly if you have a taxable estate, the use case for doing a Roth conversion, I mean, it is there, because that's money that when you pay that in tax, you're not paying 45% death tax on the money that you're paying in tax.
Mm-hmm.
All right, let's look at some case studies. This looks interesting.
Yeah, so this one is super simple, actually. And this, what this case illustrates is simply what the impact of a Roth conversion will do. So we took a couple 64 retiring very soon, taxable assets of 1.5, retirement assets of 5 million, and a primary residence worth $2.5 million here in California. They have no guaranteed income or other sources of income, rental income or otherwise, except for Social Security. And so what we did was we simply isolated what the impact of doing $150,000 Roth conversion annually from retirement until the year before they start their required minimum distributions, and then taking a qualified charitable distribution once their RMDs start. Now, what a qualified charitable distribution is the ability to take a part of your RMD, your required minimum distribution that the government says you have to take out, and send it directly to a charity. So the benefit of doing that is that rather than, taking the distribution and then taking a charitable deduction on your income taxes, when you do a qualified charitable distribution, that $50,000 never gets included in your income. So it does not count towards your AGI. So for things like the IRMA or the adjusted amount that your potential Medicare benefits may cost a little bit more, it doesn't impact for that. Doesn't, can make a difference too when it comes to other things that are impacted by AGI deductions and those sort of things. So very crucial tactic. And with all of the changes that Secure Act and Secure Act 2.0 have made, moving the date of the required minimum distribution forward, they have not changed the date that you can start making a qualified charitable distribution. So you can still make a qualified charitable distribution at 70 and a half versus now RMDs start at 73. So still an interesting tactic. But if we look at the next slide, Jim, this is really a visual of some of the planning that we have the capability of doing and the things that we work on with clients. This is a very simple, isolated example where we're just looking at a Roth conversion. Someone with a real situation would have many more variables, but even just isolating Roth conversion, what this graph is showing us over time is someone's projected portfolio value based on assumptions of historical returns for what they are currently invested in, and then making those Roth conversions. It helps us see that over the course of their retirement life, that annual Roth conversion is projected to gain them $3.2 million in portfolio assets over time. The reason for that is that their required minimum distributions are so much less in the future. They're paying less taxes in the future. And so that money just continues to compound and grow over time. But I think the important thing here is yes, I want to talk about Roth conversions and the impact, but I think the visual of what a financial plan should be for you is something that can illustrate for you the real life impact that you may experience over time and how different variables, different what if scenarios change that picture and making it digestible in a really visual way. So that was portfolio value that we were just looking at. This is tax impact. So on the left, what we're seeing is that couple's projected income taxes over time. And you can see that there is a number of years where it essentially falls to zero. And that's because after they retire, before they start taking RMDs, they're living off of their qualified assets. They're not paying any income taxes. But what we have the opportunity to do in that gap between when income comes down from retirement and when RMDs start is we can do those Roth conversions and start filling in those tax years to kind of smooth the ride out over time. And one thing I will point out about these two graphs is that they're not on the same scale. The one on the right tops out at 750. So take those bars even further down if you are really comparing apples to apples. In this example, with her living out into her mid-90s, doing those Roth conversions and qualified charitable distributions is saving them $3 million in taxes over their lifetimes.
Yeah, Shannon, I think the takeaway from this is if you're watching this video and you're like, I don't really understand what's going on. There's a lot of graphs, there's a lot of acronyms, there's a lot of taxes. This is all kind of scary. You have a period of time as a taxpayer between when you stop working and your earned income goes to zero, right? And you might be living off savings, but your earned income goes to zero. And then your required beginning date, or when your required minimum distributions start happening at 73. So if you retire at 60, you've got 14 tax years, right? Where you can do some planning. And why would you waste a low income tax bracket? So it's kind of really flipping taxes on its head, right? Why wouldn't you do a Roth conversion if you can be paying taxes at 22% or whatever it is? Like that makes sense because you're going to be at 37 right? 37.9 in the future. And by the way, we're at a very low point when it comes to income tax. I saw a study a couple months ago. Over the last 4 or 5 years, worldwide, a greater share of the gross domestic product of all the countries is going to tax. It's because we have an aging population. If you think taxes are going down, I think that's optimistic. I mean, I'll put it that way. I think taxes are going up. I'm not advocating that taxes go up, but I just don't see them going down, right? Because we've got this sort of shrinking workforce. Just it's pure demographics. So I'll get off my soapbox.
So this is the risk mitigation and insurance slide. So this is just a way to kind of high level talk about insurance and repurposing potential insurance products that you already own or adding that to your existing portfolio. So this is just a real opportunity. What are your largest risks in retirement? And you'll see on the top of the umbrella is protecting you through the way of insurance from any long-term care risk or market volatility risk, or if there's a premature death or disability, especially if you're on the beginning half of your life, those are really concerning for people that are raising a family. So, and then on the back end, long-term care, and your needs may shift. And so a lot of people, if they have existing life insurance policies, as they age and as your family grows and as your debt ratios come down and income replacement isn't as big of a issue, how do you then protect your nest egg? And insurance is a really good way to do that. That's mitigating any of those additional risks like a healthcare event where you might potentially need long-term care. There's an 80% likelihood that you will need long-term care in your lifetime in some form or fashion. A lot of people think of long-term care as moving out of their home or moving into a facility or, being there for a long period of time. It doesn't have to be that, but to some extent, there might be some need for some additional assistance, whether that be in your home or otherwise. How much coverage is enough coverage? That's a question that we get asked all the time. And it's really, when it comes to long-term care, when we're speaking of that, it's not designed to totally replace the cost of long-term care. I mean, that's great if your policy does do that. A lot of people have these old Genworth policies that they bought forever ago that have 5% compound inflation, and maybe their benefit is $20,000 a month, and they have that for themselves. And those are fantastic. And that will large in a way cover great majority of the cost plus some for long-term care. But not more often than not, we see smaller policies that are just designed to supplement or create some sort of a cover over your existing assets. And anything that comes out of a long-term care policy is tax-free to you. So it's a great way to mitigate tax exposure as well. So if you did have a need where you have to access funds or potentially access funds, you can use this insurance policy and get a one-for-one, dollar-for-dollar out for whatever you're needing to meet from a needs perspective versus paying the IRS first and then using the net to cover whatever exposure you have. So it's a really great way to mitigate that sequence of returns or sequence of returns on your retirement where you might have market volatility and you're paying in a market drawdown, you're paying that expense first and then the IRS, and then you're left with a much smaller number than what you would expect. And so it's really helping to mitigate that exposure, especially in retirement, from having these negative draws on or negative impacts on your portfolio. When you're raising a family, I mean, we did an insurance webinar, and DIME is typically the acronym that is used. It's debt, income, I'm blanking on the M right now, but it's expenses, education, mortgage. What are those costs? You add all those up, and you typically want to say, I need 10 times income. I need to cover all of my debts, future education expenses. Those are great ways to think about how much coverage you actually might need. How much guaranteed income do you have in retirement? So that's kind of the annuity piece of this. Insurance is wrapped up in, or annuities are a portion of insurance or a way to use that. So, annuities are a way to supplement additional retirement income. If you have existing life insurance policies that have cash value, we can use those to repurpose those into some sort of an income stream as a Roth alternative. That's a really great strategy. Doing in addition to doing some Roth conversions in this low tax environment, if you have large IRAs, can we shift some of that income as part of an IRA strip out strategy and use that to pay premiums on on a life insurance policy and then get you tax-free income in the form of a loan? These are all unique ways to utilize insurance to cover, create peace of mind and just eliminate some additional exposure and transfer that risk from your existing portfolio you worked your whole lifetime for to having an insurance company cover those costs for you.
Yeah, I
And
know
so,
you've
oops,
helped
sorry.
you've helped people out in the past. So if you have like an old life insurance policy with cash value, you can repurpose that and you can move that policy over to a different type of policy that's long-term care. So you take that cash value that really you don't really need it, right? Maybe you've put your kids through school, you paid off the mortgage, you have your retirement set up, and you're concerned about the risk associated with long-term care, meaning the financial risk. You can put, if you got 100 grand in cash value, you can put that into a policy. And what are you seeing in terms of, is it like 3x coverage, 2x coverage,
Yeah.
4x? What are you seeing as a,
Typically, it depends. I mean, it really depends on your existing health. So if you're in good health, more often than not, we can possibly get you a 3x on that coverage. So if you have a $100,000 death benefit, you might get, $300,000 for long-term care. And the type of care you get is also, is it an indemnity policy? We talked more about that on the insurance policy, but it's how they pay as well. I mean, what are your needs? What are your greatest concerns? Do you want to have a residual death benefit? Is that important to you? It's really assessing all those needs for you.
Mhm. Absolutely. And it's funny because one of my main takeaways from talking about insurance is like, it's not just like a lot of people think about home insurance or car insurance where you pay something and then you're insuring against a risk. In a lot of different ways, insurance policies and annuities can become part of your investment portfolio as well in certain ways. And so, when we think about investment planning, we're also considering what's happening in your insurance policies, your annuity contracts. At its very simplest form, investment planning for us is really about risk and risk mitigation. We could talk at length about, what asset classes to be in and when. But I think really in the context of a financial plan, investment planning is about making sure that you have the right amount of risks in your portfolio. And you can do that by making sure that you've got proper diversification, that you're in different asset classes, in different companies, in different types of investments, that you are being tactical about that asset allocation, that you are not simply buying and holding something, without any care for what's happening in the market or what's impacting that particular asset class in the overall economy. And Jim, you mentioned this earlier, that as you get closer to retirement,
yep.
perhaps your appetite for risk comes down. And so you need to adjust that a little bit. I insisted that this slide be put in here because I am the investment management nerd. And the reason for this is because I really think that risk adjusted returns is the most important thing when it comes to talking about investment management as part of a financial plan. We identify, based on what you've told us about your goals, what you want your lifestyle to look like, and what your assets currently are, the appropriate amount of risk for you to take on. And then at that given level of risk, our job as investment planners is to go out and find the investments that will give you the best return at that given risk level. We hear so often, well, why don't we just put this all in, you name the tech stock that's up 30% that year? Well, the reason for that is that it could also be down 40% in that year. So we need to be thinking about the risk that we're taking on in relation to the reward that we're getting for that. And that's what a Sharpe ratio is. It's something that we look at when we're identifying every single investment, is we look at, for each unit of risk that you're taking on, how much reward are you being given? And so oftentimes it could be that the investment that has a slightly lower return might actually have the better risk adjusted return because it's not as risky.
I agree with you. I'm really glad you put this slide in here. I think this is probably the single most important slide in the whole deck. And the reason it's important is people look at this and they go, I have no idea what you're talking about. So for those of you who play craps or gamble in Vegas and play table games, there are certain, I like to play craps and blackjack when I go to Vegas. I'm not a big gambler, but I like to play it. There are certain bets I absolutely will not make on a craps table. There's certain strategies. I won't sit at a table that pays 6 to 5. There's no point. The house has like a 400% greater advantage. This is kind of the same thing. And I hate to use a gambling analogy because investing is not gambling, but I really want to give a concrete example. Why would you make a bet that where the odds really, you would want to take the best odds, right? And you wouldn't want to take the worst odds. And that's kind of what you're talking about here is for the return you're getting, what kind of risk do you have to put up? And when you look at this, you're way better off with portfolio B, right? That's correct, right?
Yeah, because for every unit of risk that you're taking on, you're
Right.
getting 1.5 units of return from portfolio B.
And what I hear from people is they go, well, I don't want to waste money on a financial advisor. I'm going to do an ETF in the S&P 500. When you do an ETF in the S&P 500, where is that on the Sharpe ratio? What is it?
I mean, it depends on what time frame you're
Yeah.
looking at, but it can be really high.
Yeah.
Because especially in a situation like we're in right now, it'll also vary over time. You know, there are 7 names that make up 1/3 of the S&P 500 right now. So you buy the S&P 500 thinking, oh, I'm getting great diversification. It's 500 different stocks. Well, not really. I mean, most of your investment is in 7 stocks.
Yeah.
So it's very, very important.
And we'll have clients who have worked at a company and they might have a lot of company stock, and to have a big position in a stock that's also a big part of the S&P 500, you might want to, if you're going to invest in the S&P 500, you would want to back that particular stock out because you're already overweighted, because you're just getting, even more overweighted on that. So this is a really important slide. I really like this. This is very important to understand the return for the corresponding risk. So sometimes it does not make sense to chase a higher return because you have a higher probability of a downside.
Absolutely. Common investor mistakes. We've spent a lot of time talking about this across different webinars. And there are, obvious ones like having over concentration, like Jim just mentioned, or chasing after trends. We heard a lot about AI earlier this year, and we saw so much money go in there, and some names are going to be successful, but by and large, a lot of them will not be. Trading too much, failure to diversify, that's that over concentration, taking on inappropriate risk. But one I bolded here is letting emotions rule. And reason that I bolded that is because it really ties into the last sort of pillar of financial planning, which is that psychology of financial planning. Having someone who understands from the larger perspective where your goals are and why you have made the decisions that you've made helps you stick to that course. Not to say that financial plans are, set it and forget it. They have to be adjusted along the way, but keeping that panic out of your kind of decision-making process is really important. There is a study called the Dalbar study that's really famous in our industry, and it looks at the S&P 500. If you had just invested in the S&P 500 in January of 1993 and held it through the end of 2022, what would your return have been like? That return would have been averaged about 9.65% over the course of that period. So a wonderful average annualized return. But when we look at what people's actual experienced returns were, they averaged less than 7%. And the reason for that is their behavior, their decision to buy and sell, trying to kind of time the market. So that graph on the left shows the opportunity that has been missed. You invest it and you leave it there, grows to $1.5 million. The average experience was actually that $100,000 only grew to $700,000 because of the decisions that they made. The reason for that is on the next slide, because you never know when the best days in the market are going to be. And so if you miss out on a couple of the best days in the market, your overall average return can be really impacted. And this is just looking at the S&P 500. Every different asset class is going to have, its different characteristics. But a different way to look at this, since January of 2003, you invest $10,000, you don't touch it, it's $65,000 by the end of 2022. If you had missed just the 10 best days during that time period, so every other day you are invested, but not the 10 best, you only have $30,000. That's $35,000 that is missed by not being invested for 10 days. And the little words above it, I think, are the most important words on this slide. 7 of those 10 best days took place in bear markets. So when the market is not in a positive condition, when we are experiencing kind of a downward trend, 70% of the best days during that 20-year time period were in those negative market conditions. So you really never know when you're going to get rewarded for participating. And so that's why, generally speaking, participating is better than not.
Yeah, it's really hard. There's a certain randomness to it. And if people could time the market, people would be timing the market.
Yeah. What's your dad say, Alyssa, about that?
Yeah, market timers Hall of Fame is an empty room. There's no such thing as being good at it. If everyone was good at it, we would have a lot more wealth than we do today.
Absolutely. So kind of tying that all together, having the right financial advisor that is putting together a financial plan for you that really does incorporate all these areas. I think from somebody who this is I can't express how passionate I am about this this topic. For someone who really sees the value in it, it's frustrating to me how often words like comprehensive or holistic get thrown around. And really, that advisor might just be making investment suggestions for someone. So it's really important to make sure that your advisor is asking you these sort of questions that we've gone over today and talking about all of these different areas of your financial life, because every one of them will impact your success in reaching your goals. This slide here shows Russell Investments did a study looking at what working with the right financial advisor can do for your overall success. They do this every single year. These are the numbers for 2023. And so they kind of pull out what are the 4 areas where they see adding the most valuable. The first is investment management, which we talked about is really the smallest piece, and it's also the smallest number on this slide. Having somebody who is making suggestions on an active basis about your asset allocation does add a bit of value over the course of a year, maybe less than 1/3%. Tax efficient planning and investing over 1%, just making sure that the assets that you have are in the right registration. There are certain types of registrations where you don't pay taxes, and there are other types of accounts where you do pay taxes along the way, making sure that somebody's managing that for you. Comprehensive and specific wealth planning adds over a percentage in value. So making sure that you have somebody that is looking for the risks and opportunities that you haven't seen yet and asking you the questions that you haven't asked yourself yet. That is where so much of the value of a financial plan comes from. And interestingly enough, the most important aspect that a financial advisor adds value is in that behavioral coaching, is in helping you make the right decisions, which I don't think that will surprise anybody, but probably over half of the value is in helping you make the right decisions.
Wow, that. Where did you get this from? So you got this Russell Investments?
Yeah,
This is
Russell
fantastic.
Investments, they do it every year. They've done
Great.
it, over a decade, and they've got a lot of takeaways. And
We can put the link in the chat
Yeah, that'd
afterwards,
be
or
great.
in the
Yeah, we'll put that in
questions
the notes.
afterwards. It's a great link to have.
And really, this is the 3-legged stool when it comes to, our focus is multi-generational wealth creation and transfer and protection. And really, it's the certified financial planner working with the tax advisor, CPA, and the lawyer working together as a team. I will tell you, it is not in every case that I work with the other advisors as a team, but when we do, it's fantastic. Okay. It's always better than not working together. I can't think of a single instance where working together is worse than not working together. It's much better outcome for clients. It's much better outcome. If you're watching this and you're working with a team, and I like to say, just as a real world example, I want the cell phone number of the CPA and the financial advisor, because I'm going to be able to get through the gatekeepers and just have a quick interaction. And we do meet. We have mutual clients we meet with, several mutual clients, and some of them are, we meet more than one time a year. And obviously, it's going to be a higher net worth person, but I think we have significantly better outcomes for our clients and their families. So very, very important. If you're watching this on YouTube, go ahead and hit subscribe to our YouTube channel. And if you're watching this on YouTube and you're like, what, you guys record these live? Go to our website and sign up for a webinar. So we have offices throughout California, Northern and Southern California. And this is the contact information for Ascent Wealth Management as well as Cunningham Legal. We got the phone numbers, myascentwealth.com and cunninghamlegal.com. And we have coming up our April 4th, retiring in California, pros and cons. We're going to unpack this. And a lot of people go, there's no way I'd retire in California. And other people are like, I'm never leaving, or I want to move to California as quickly as possible. And so we'll cover the pros and cons, some tangible, some cultural stuff. We'll talk about some financial stuff. We'll talk about taxes. A little bit of a spoiler alert: California does not tax your Social Security, so it's kind of cool. And again, subscribe to our YouTube channel. And here's our information. I am going to open it up for some questions. And if you have any questions, go ahead and put those in the Q&A. And if you're watching this on YouTube, what's going to happen is Shannon and Alyssa and I are going to go away, and there's going to be another YouTube video that rolls up. So don't go anywhere.